Hi, this is Osama Rizvi and welcome to another episode of Monday Mac Review. Um, Recently, lots of developments have been happening, of course, but I want to talk about two specific things. One, the oil markets. It's been a while that I have commented on that, and secondly, the bank run. Of course, the Silicon Valley bank run. So, before we start analyzing what's happening, the point here is to understand that the risks, the inconsistencies, the highly concentrated books, the financial intrigues, all of these things were already present. They were there, lurking in the corners. And what happened with SVB, or what followed, also with Credit Suisse and other banks, it was just one of those, torches that sort of highlighted that problem, but the problem was already there. So to look at it from this point of view, that something triggered this, is a little bit problematic. Yeah, it triggered it, but these things have been there from quite a while. And that is why I also believe that this event has all the trappings, if you may, to initiate or to trigger a global financial crisis. Of course, with this, you have the cementing narrative of sticky inflation. You have the revisited version of by the Fed of rising interest rate. You have that change in the peak of interest rate, which is now at 6% somewhere. It might be more than that. And all of this ties down and presents some of the most pressing challenges as we move forward into the year 2023. So, what happened with SVP? First of all, look at this interesting chart. 97%, almost 97% of the deposits were uninsured. Only 3% were insured. Of course, FDIC dictates that only the deposit less than or equal to $250,000 will be insured, but they had most of the deposits were more than that. But the reasons, as I show in this slide, is amongst many, three main reasons. So there is a thing called asset liability mismatch. Banks all across the world, they're mostly responsible for lending, right? But so there is a loan to deposit ratio, for instance, in Asia. So we have been talking about the spillover of this in other continents. So Asian banks have almost 90% loan to deposit ratio. That makes them quite secure. However, they had most of their money, most of the deposits invested not in short-term assets, but in long-term assets like the mortgage-backed securities, which we all know have been doing really well. So that sort of created a mismatch. And with the rising interest rates were just part of the puzzle, a part of the picture. With the rising interest rates, what happened was that there was a liquidity crunch, and then what formed share prices fell, and a bank run, the classic bank run of it. Then the whole book, most of the deposits were by venture capitalist firms, but at the front there might be hundreds of firms, but in the back end there were about 10 or 15 or 20 firms that sponsored all of those firms. So the book was highly concentrated. Thirdly, they were lightly regulated. It isn't a surprise now, and everyone knows that for many months they even had no chief risk officer. So that's absolutely mind-boggling that a company of almost 16th largest bank in the US had no risk officer. So these are few of the reasons. I'm not an expert in banking, but as everyone was trying to give their version of this, I thought it's important. I mean, the Monday Mac Review wouldn't be complete without mentioning the SVB saga. Interestingly, another bank. So there have been other sort of defaults as bankruptcies as well, but the Credit Suisse one matters a lot because given its status as the global in the global financial system, they have been recently being sort of purchased, saved. However, it still shows that inconsistencies, if we probe into them, they would be abundant across the spectrum. And that is where I believe this financialization, the securitization, the ultra-financialization of the economy becomes problematic. There is real economy, then there's a financial economy, this financial economy, and the problems within, they spill over into the real economy as well. So that's it. That is where it becomes problematic for people. Coming to the problems, I would also like to speak a little bit about Fed and what's happening in regarding the recession narrative. So this is by Francois Trahan. I don't know if I'm pronouncing his name correctly. Apologies for that, but I've written his resource. This is from LinkedIn, his LinkedIn. He does these amazing charts, and he shows that how it's been more than 7-8 months that the yield curve is inverted, and that definitely predicts that the recession that would naturally be the outcome of this at some point would also last for a few quarters as well. Why do I always try to mention these things? Because, I like to cement this fact that despite we're getting, some, the whole narrative is being punctuated by rosy outlooks, I think we're still not there. Fed's own PCE estimation, they show quite high, is on the higher side, which means that, we will be expecting further tightening. Speaking about oil markets, so oil markets are really interesting at this point. Oil had a sell-off about more than 10%. Oil prices are at their lowest level in the past 15 years. That's very interesting because if you look at the fundamentals, this is all the paper markets or the physical markets, fundamentals more or less remain the same. US and Europe and advanced economies are expected to shed some barrels in the form of oil demand, whereas China will be offsetting those that decrease by an increase in its demand. So it will be more or less, give or take, a balanced equation in terms of demand and supply. This by chart by Vortexa shows that Russian oil production and Russian oil exports have been doing pretty well. In fact, Russian exports spiked in early March, led by the diesel exports out of the Black Sea and the residue exports. And only a limited amount of Russian oil remains in floating storage. That is because of the delays in processing and other things. So what are we looking at is that I do not see a supply constraint at the moment. A demand curtailment remains a real and impending risk. In this slide, you can see that the open interest in oil contracts, which are reported by both CFTC and ICE, it went up naturally when oil prices have fallen about 10%. We will see a retracement of prices. Prices will rise a little bit. But my bearish case for oil still remains because I think oil prices will not be going to the $100 mark. All of this, of course, has a bit of overrepresentativeness or bad news as there is a bank run and concerns about US financial system. But of course, that will settle down with time. Market sentiment tracker finally. You can see that the left side, the recessionary side, that it is get heavier collapse of the SBB. The whole banking industry has come into discussion. Conference boards index fell about 0.3% in Feb, which was the 11th consecutive decline. Manufacturing activity is still down. PCE is still expected to rise. So yeah, I think that the systemic risk that we have just seen can easily trigger a contagion. Europe has improved a little bit in terms of inflation. Oil prices have fallen. Retail pressure has decreased. On the US economy shows a little bit of cooling down, but not to the extent. Oil gas prices are below, but not when you compare them to the 4 or 5 year moving averages. I think it looks balanced, but the significance of the bearish factors outweigh that of the bullish ones. So that's all from today. I hope to see you next week. Until then, have a great time.